Hello and welcome to episode 16 of Making Sense. It's a special episode. You definitely want to listen to this one because the show is for you and it's about you. It's based on your questions. My name is Emil, Kalinowski, and of course this is a Eurodollar University production. And joining me as always is Jeff Snider, the head of global research for Alhambra Investments. He's been referred to as the Yoda of the Eurodollar, but for our purposes today, he's going to be known as the Cliff Clavin of the Eurodollar, because we're going to be doing a Jeopardy style Eurodollar episode where we're going to be going through mailbag questions. And we're going to do a 30-minute episode starting now. And Jeff will have categories to pick from, and we'll see what kind of score he can rack up by the end of the 30 minutes. So Jeff, welcome.
Thanks, Emil. I'm looking forward to this. Let me tell you.
Nobody will be harmed after this show. So we've got some
There's a lot of pressure. You've started out putting me really under the gun here. I mean, comparing me to Cliff Clavin, the most famous mailman of all time. I mean, that's a lot to live up to.
Not only the most famous mailman, but I think the best Jeopardy contestant in all time. I don't care about the show that they did this year about the Jeopardy champions. That's a whole conspiracy on how he didn't get on this year.
Yes. Who will ever forget his answer in Final Jeopardy? Who are three people who have never been in my kitchen? Absolutely correct. Exactly right.
It was absolutely correct. And we'll see if you can answer the Final Jeopardy question today, as well as Cliff Clavin. Let us start. Okay. Your five categories are inflation, central banks, financial institutions, measuring money, and potpourri. Where would you like to start, Jeff?
I think we have to start with central banks.
Central banks. Very well. Let me set this up here. There it is, central banks. Can you see that okay, Jeff?
Yep, we're good.
All right. We've got 6 questions. The $100, $200, $300, $400, $500, and $600 question. Which one would you like to go for first?
We got to go for 600.
All right. Let's go to Austin Deerdorf. So this is a good question. Also, it's specifically about Germany, but it also applies to Japan and maybe one day to the United States. And the idea is the bond market is supposed to be sending us signals. But what happens if the central banks buy up all or almost all of the bonds? Can we really rely on the bond market anymore?
Absolutely, because central banks who buy bonds are just buying bonds according to a predetermined list. They're not buying bonds because of economic reasons or changes in the marketplace or changes in the economy. They're doing so based on strict bureaucratically determined rules and limitations. So the market that's left, that's actually a market, will still be trading based upon market factors, economic factors, and the very kinds of things that we want to see happen. So it is possible, even under an environment where central banks are the biggest owner out there, that the market just simply adjusts to what the central bank is doing, and you have to reinterpret the signals in that context. But at the margins, the market is still the market.
Would you like to stay in the same category?
Same category, 500.
Kev Pin. Well, you can see the question there. My understanding is that dollars from Fed printing sits as inert excess reserves. Yes. Does BLK and the other new policy programs, do they get excess reserves when they sell ETFs to the Fed, or actual US dollars that can circulate? Are these new policies by the Fed creating more volatile, more exciting money? Jeff?
No, it's the same. It's basically the same thing. And again, the Fed is only transacting with primary dealer banks, and that's the offset. So they give the dealers the reserves, and then the reserves go to the banks, who then go to the marketplace and buy what the Fed wants them to buy. So it's still the same shell game. It's still the same puppet show, as I like to call it. And the end result is an increase in the level of bank reserves. And really, the whole point of these programs isn't so much to increase the level of bank reserves as it is to reassure market participants that Jay Powell's got your back. Don't you ever think about selling an asset ever again, because the Fed's got it all covered. That's really the whole point here. And if it raises the level of bank reserves, and some people interpret that as money printing, all the better, because that plays into what the Fed really wants to see in a deflationary environment, which is an increase in inflation expectations. So that's, as far as Jay Powell's concerned, it's good all the way around.
Would you like to stay in the same category, Jeff?
Let's go to a different category. Let's try potpourri.
Potpourri it is. We've only got a couple of questions in here.
That's okay. We'll start with the first one.
All right, sounds good. Here it is, potpourri. We've got 3 questions in this one, actually, and the first one comes from Lucas Roberts. Has Jeff read The Holy Grail of Macroeconomics by Richard Koo? And of course, if you haven't, I'm sure you've heard of at least the idea of the balance sheet recession. Can you talk a little bit about that?
Yeah, I've never read it. I've never really been a big fan of Mr. Koo. And as far as balance sheet recession goes, I mean, that could have made sense up to about 2011 or 2012. But at some point, if we're talking about a balance sheet recession, if people understand what a balance sheet recession is that
I don't. Can you tell us what it is?
It's basically the idea that the people, whether companies, persons, think about it in terms of the mortgage, the housing bubble, and the mortgage credit bubble that happened in the middle 2000s. People essentially take on too much debt, and therefore there has to be a period of deleveraging, whereby people work out their debts and get down to a level that's sustainable to their basic income. And in between, of course, you have what is called a balance sheet recession, which some people thought that maybe 2008, 2009, the Great Recession, had been a balance sheet recession, and it made sense. We had a massive credit growth through the 90s into in the middle 2000s, and therefore it seemed like, okay, if we have a balance sheet recession, then we just have to work through this deleveraging process, whereby after a couple of years, enough debt is extinguished, people get down to a reasonable level of debt in their own lives and their own corporate situations, that the economy starts growing again. And in the balance sheet recession, it really kind of looks the same way, where there's really not much a central bank can do, because deleveraging is going to happen no matter what. Now, I think Koo's argument is more nuanced than that, and I'm oversimplifying a lot of the things here, but that's the basic gist of it. That once we got through this deleveraging process, that was it. Like a switch, everything would go back to normal. And of course, as you and I, Emil, we know this very well. That's not what happened. You could tell that was going to be the case right from the beginning, because first of all, 2011 and 2012, you had another liquidity event, which a liquidity event is inconsistent with the idea of a balance sheet recession. And then all your beautiful charts that you prepared, Emil, that show that 2008, 2009 wasn't a balance sheet recession. It was an inflection in credit and money. So it wasn't like this was a temporary setback where we deleveraged to a reasonable level. More so, it was a complete paradigm shift in the money and banking background behind the entire system.
Tell me if I've got this right. So a balance sheet recession is it's heavily focused on debt. There's too much debt. Okay, we reset, deleverage a little bit. But the liquidity is always there, right? To take off again. Is that what's missing from his?
It's not that the banking system is missing money. It's that the demand for credit falls off because people are deleveraging, companies are deleveraging, whatever it is. And so as long as that deleveraging goes on, it's really, you have to be along for the ride. But the other part about that is, at some point, you have enough. Enough is enough. You get enough deleveraging and the thing turns around. Well, here we are in 2020, the thing never turned around. Is 13 years not enough time to deleverage? Well, of course not. I mean, it's a nonsensical argument. And it was, like I said, it was pretty obvious that wasn't the case all along, because you had right away in 2010, we had these liquidity events popped up that were inconsistent with the idea of lack of demand for credit. It was about the supply of money. You saw that in May of 2000. I mean, right away, it was pretty obvious that this was a liquidity change, and especially after 2011, where it became even more evident that there was a paradigm shift, not a temporary balance sheet deleveraging, but a paradigm shift underneath all that on the supply side in banking and credit. And then, therefore, because of the lines between credit and money have blurred so much, banks are money and credit simultaneously.
Excellent, excellent. Categories are inflation, central banks, financial institutions, measuring money, and potpourri. Where would you like to go
with
next,
inflation.
Jeff?
How about inflation?
Let's do it. Would you like to go at the 100, 500, or in between?
Let's go in between.
Let's go to Yaha85441345 from Twitter. There it is. Jeff, how do you see negative supply shocks and deglobalization affecting inflation while QE doesn't? This is kind of a question that I see often in the YouTube comment section, is that you often say that inflation is a monetary phenomenon, but people say, well, what about supply shocks, deglobalization? Won't that affect inflation? But is it a persistent issue versus a transitory inflation moment?
Yeah, we're talking about inflation burst versus inflationary environment. An inflationary environment, which I think most people associate with inflation, is a monetary phenomenon. Whereas in a supply shock, these things happen all the time. In fact, I just wrote about the one that showed up in 1947 and 1948, which the Federal Reserve interpreted as a switch out of the Great Depression deflationary environment and into an inflationary environment that they had been fearing since 1934. And of course, that wasn't the case. Even though the CPI got up into the double digits in 1947 and the Fed went nuts over that kind of a thing, it was not an inflationary, it was not to switch to an inflationary environment. It was a supply shock. It related to Europe coming back online, the Marshall Plan, the sudden burst of demand, despite the fact that the American economy in particular was still transitioning from wartime footing. And so you had this rapid spike in acceleration in consumer prices that was not monetary in nature, and therefore it was only short term. Because what happens when you have a supply shock is that eventually the market adjusts. That's what you would expect to happen. And so as the market adjusts, the temporary burst of inflation goes away. And in fact, that's exactly what we saw in the bond market in 47 and 48, was that long-term yields really didn't change that much. In fact, it was so small, the fact that the Fed overreacted to it, you just shake your head and wonder what the hell these guys are thinking. And of course, the truth is they don't understand money and banking so much as they understand bonds and yields and their relationship to them. But the point is that, yeah, supply shocks happen all the time. The market adjusts to them. It can end up creating a temporary burst of inflation, sometimes very severe burst of inflation. But that's not the same as a monetary or inflationary environment that's based upon or that's predicated upon monetary imbalances.
Jeff, we're coming up on our break. And before we get there, we still have room for one more question. So where would you like to go?
Same category. Let's go for the next one.
All right. This next one is coming from Twitter as well, at Dennis Cutman. And if the U.S. really wants to create inflation to counter the current deflation, how can the Fed and the government incentivize the banks to make loans, which creates new credits? I really like this, the angle we're going here with Dennis. He's asking not how the government or the Fed can create inflation, it's how do we get the banks to do it for them?
Yeah, and it's how do you get the Fed and the government to get the banks to do it for them? Mm-hmm. And that's really what the central banks have been trying to do for the last 13 years. And obviously it hasn't worked. And then, look, I mean, the central banks have, in their mind, they've tried everything. Negative interest rates. What is negative interest rates? Negative interest rates are essentially a penalty to the banking system for not creating the monetary money and credit that would lead to inflation. And so in Europe, Japan, and all these other places, central banks have been trying to prod and harm the banking system and say, hey, look, I'm going to penalize you unless you do something with your balance sheet. Start doing something risky to create the positive forces that we believe lead to inflation. And what have the banks said? We'll just pay the penalty and do the same stuff we're always doing, which was retreat, get smaller, get more efficient, those kinds of things that are deflationary. So obviously, after 13 years, central banks and government haven't been able to put their finger on what exactly would be the right way to get the banking system to behave in an inflationary manner. And so that doesn't leave us a whole lot of options. And it's really the big question out there is how do we turn this thing around? And I don't think the answer is some simple policy or a combination of policies under the current paradigm. I think it has to be, even in terms of orthodox economics, it's about credibility. Does central banks or do central banks and government have the credibility to convince the banking system that they should go out and take lots of risks again? And I don't think they do. And I don't think there's any way to change that except by changing the entire system itself. I think the monetary system in particular, needs to be reformed in a way that it can be stable and stable in such a way that the banking system sees that it's stable and therefore reacts to that, rather than this continual circus of one parade of QE or one thing, NERP, whatever it is, one thing after another that everybody knows, at least everybody inside the banking system knows, isn't going to work no matter how much it's sold to the public. So the answer is, okay, if we're going to continue with the banking system, then we need a credible monetary environment that allows them to take risks again, which I don't think is the right way to go either, because we really don't want to go back to the middle 2000s. That wasn't very good. That wasn't a really good period either. And then the other option is to have a monetary system that isn't bank-centered. And then you're talking about a much bigger project than just a simple policy or two. So there is no easy answer here, which is my way of saying there's a lack of an answer.
The judges are going to have a real difficult time scoring that answer. On the one hand, it's correct. On the other hand, it's not an answer, but maybe that's the answer.
It's a Cliff Clavin answer. I think I just Clavined it.
Jeff, it's going to take a big project. Let's talk a little bit about you. This is what Alex does every time after the break. He comes back. He asks what their favorite, 4th of July food is. Is it hot dog? Is it hamburger? Jeff, why are we doing this show? What do you envision project-wise that this show and this wider effort will become?
Well, the podcast, the Eurodollar University Making Sense, was first of all to get to partner with somebody like you, who was actually very good and relatable, as opposed to me, who is somewhat more of maybe a little bit harder to listen to at times. So that's number one. Is what we're trying to do together is to get people interested in the topic. And the idea is, look, there's something wrong with the system. There's something wrong especially with the banking and monetary system. Central banks don't have any answers. And by the way, they know that on some level, but that's the whole point behind expectations policy. So we want to get people interested in the ideas and the topics and raise all of these issues that people can then try to interpret their own understanding, their own way of understanding the world. But this is also just an introduction into what we hope will be a much larger scale project where we actually supply more of the answers and more of the research, the background, tell you where to go to find information, all these kinds of things. How do you read the tick data? What does it tell you? Why does it tell you these things? What is the history? So this is an introduction into what we hope will get people interested in a much larger world, which is this Eurodollar global money system that has existed for half a century, but has been completely unexplored basically the entire time.
It's been unexplored, especially recently. That's what I always bring up, is that there was knowledge, there was focus, there was interest. And then in the 80s, but that's for another show, because we've got 13 minutes left in this Jeopardy session. Jeff, the categories: inflation, central banks, financial institutions, measuring money, potpourri.
Let's do measuring money.
We've got 3 questions here: 100, 200, 300. Which one would you like to go for? 300?
I think so.
All right. It's from Cisco S, the Divisia data series. I think it's really only predominantly used in the United Kingdom, although other countries measure it, but maybe they don't report it. But this Divisia data series makes more intuitive sense to Cisco S as compared to the current monetary aggregates that we think of as M1, M2, M3, M4. Do you have an opinion on this data series?
This particular data series, I don't know enough about it to render a technical opinion. What I will say is that I do like the idea behind, it's not just the UK, there's also the Japanese, for example, which is so ironic. But the Japanese, for example, have tried to put together much higher level monetary aggregates too. So I like the idea that the official governments, central banks in some places around the world are at least exploring the idea that, okay, number one, we can't really accurately measure money because of what Greenspan called the proliferation of financial products. So number two, maybe that's an important thing we should do. But here's the problem with number 3. Nobody has yet, to my knowledge, actually defined that proliferation of products so that you can properly categorize, say, an M4 and M5 or something like that. I don't think we've gotten to that point where we can put enough into these boxes and say we've got it covered. We've got all of the monetary, all those the proliferation of financial products. We've got them all into our universally comprehensive M5. And then the problem with that, even if you do that, even if you do get, say, a Divisia or M5 that does categorize properly everything that's happened today, it's obsolete tomorrow or next week or next month or next year, because that's what the Eurodollar system has really teaches you, is that money is not a static concept. And really, if you go back and look at the history of money, especially since the 18th and 19th century, that's what you really find, is that it changes form time and time and time and time again. It doesn't stand still. The Eurodollar system as it is today is nothing like what it was in the 50s. Hell, it was nothing like what it was 13 years ago when it started breaking down. So, that's another problem. As soon as I've got M5, we got it, yay, we're done. You got to start with M6 tomorrow. And so I don't know, in this kind of environment, the system that we have now, that this kind of a project can be successful, can be fully comprehensive in the way that we want it to be. And of course, that goes back to what we just said before, which is maybe we need to change the system so that we have a stabilized, more transparent, open, and I don't want to say rigid, but at least somewhat more of a measurable kind of monetary system.
But you know what? I think it can be done if our goal isn't perfect comprehensiveness. If we have a really great estimate and we have curiosity by our central banks who are continually investigating and looking for new developments, I think that would be that would be light years ahead of where we are now.
It's a worthwhile idea. I grant you that. I just wonder. I don't think it leads to where many people would think, which is to go back to the old M1, M0 days, where you could say money supply is X, therefore monetary policy is X times 5% growth. I don't think you can get into that kind of precision. And we already talked. I mean, the blurring of the lines between money and credit have made it very difficult to tell what is a loan, what is a credit, what is repo collateral is a perfect example. Is it money? Is it a loan? Is it credit? Is it debt? Is it, it's both. It's everything. And so it's very difficult to tie all these concepts together in the system we have. And that, again, maybe that leads us to the answer of we got to scrap this and go back to something that's much more simple. Not necessarily rigid, but simple.
Jeff, you have been avoiding financial institutions. I'm going to pull an audible and I'm going to force you to go to financial institutions. You've got one or two questions here. Which one would you like?
Let's do them both.
All right, let's do it. The first one is from Usper Krefus, also known as Ivan. What can banks theoretically do or buy with reserves? What are they doing with reserves nowadays anyway?
They can do anything with reserves. Reserves are basically a liquid monetary asset that's on the balance sheet. Monetary, at least according to the definitions of conventional accounting. What they're doing with those reserves is absolutely nothing. They're basically sitting there in place of what used to be deposit liabilities or wholesale interbank liabilities, any number of things. So essentially, it's an asset for the bank, it's a liability for the central bank, and it's basically one swaps for the other. The bank used to have an asset, a monetary earning asset, and they've swapped it for these bank reserves that are, I guess, technically an earning asset because the Fed does pay IOER, which is down next to nothing now. But again, it gets back into the discussion we just had about NERP. Banks are, despite penalties, despite low rates, despite low incentives to hold these kinds of assets, they're choosing to hold the safest, most liquid assets, of which these are one, because their view of the environment, their view of their own balance sheet construction factors is negative. And there's nothing that has been done over the last 13 years that has changed the situation. They've decided they're going to hoard the safest, most liquid instruments, including bank reserves, because of what? What's the answer to why would banks hoard the safest, most liquid? I mean, that's the question that central bankers and governments and financial media never seem to ask or answer. And the answer to me is pretty obvious. So,
yeah, no liquidity, too much risk. No backstop. You can't count on your central bank.
No.
Am I right on any of those?
Yep. And so if the central bank wants to give you a liquid asset for you to hold instead of, say, a treasury bill, or something else, even a mortgage bond. I mean, you hold that instead. If there was any reason or incentive for them to do anything more, they would do it. I mean, look, the IOER, especially nowadays, is nothing. So why would you get paid essentially, 25 basis points holding this liquid asset when you could go and get some, lend in some market and get some risky returns for much more than that? Why don't banks do that? To ask the question is to answer the question.
Absolutely. Next question is from Super FL. This is probably the hardest question here. So, Jeff, you have mentioned that interbank credit creation satisfies all the currency functions. And I'm thinking there are the three classic currency functions that might be referenced here.
Yeah, I don't think I've said that, though. I want to object to the question.
No problem.
In terms of what I've said about the Eurodollar system is that it only performs to two.
Which two?
I don't. Maybe I haven't been clear enough, but it does not. It's not a store of value. It's not the function. The Eurodollar was always about medium of exchange and as a byproduct of measuring things, but it was never about. In fact, it was the whole point was that it wouldn't be about store of value because you're not storing currency. You're not storing gold. There's no money in it. It's just ledger. It's just the system that allows transactions to take place between very different systems. So it's a medium of exchange. It's literally a medium of exchange, and as a byproduct, again, as a byproduct, it has become a tool of measurement, not even a good one. But I don't think it's ever been a store of value, nor was it ever intended to be a store of value. You can make the case, I suppose, that governments have been using their foreign reserves that they've taken in from the Eurodollar system as their own store of value. But even then, I would argue against that because they don't understand that it's actually not reserves as they understand them. It's simply a byproduct of being stuck with a huge dollar short need. So
it's fascinating if you think about it, because we're all taught that there are those three aspects of the of currency. What are they? Store of value, medium of exchange, and unit of account. But here we go.
Right.
We can run an entire planet's economy on just two of them.
Right, and that, think about the financial system as a whole as it evolves. Banking system in particular, especially since the Great Depression, it has it has tried to solve the store of value functions in other ways. So if we've separated our medium of exchange, that's one of the reasons why the lines between credit and money have blurred so much, is because credit has become almost exclusively the long-term store of value or the intermediate-term store of value, where money used to perform that sort of role, especially where credit itself becomes highly liquid. So that's one of the reasons why credit markets have developed for even the most esoteric products, because banking system realized that if we could, money in banking, we tie those things closely. If we could make credit products very liquid, that will take over some of the role of store of value, or some of the demand for store of value from what is a quasi semi-monetary issue or product. And so that made things incredibly, much more efficient, in one sense, much simpler. Because if the Eurodollar system didn't have to worry about value, which is why it was breaking free of the gold standard, then, in a lot of ways, it becomes a lot more elegant and doable.
Inflation, central banks, financial institutions, we've crossed out. We've got that. So inflation, central banks measuring money, and potpourri. Your last question, Jeff.
Let's go back to central banks. Got to do it.
Let's go to Nick T. How about that?
Okay.
Would Jeff have been in favor of the Fed actively intervening in the money supply to smooth out economic cycles? Jeff, because you always say they're not doing it right. Well, would you even be in favor of them doing it if they had known what they were doing? And then it's kind of a follow-up. What about letting the markets just take care of everything on their own, the natural order?
No, I'm not in favor of using money supply for any reason other than supplying money. That's the whole point. I don't think that economists should be in the business of managing economies. I don't think they do it well. I don't think you can do it well. I think the entire point of a central bank should be the old mechanical style central bank, where when the global marketplace or even the local marketplace desires more currency to do normal functions, and it's not up to the central bank to decide what's normal, what's abnormal. When there's demand for money and there's a shortage of money, then the central bank needs to step in and supply it. And you think back, to the old weather vane that goes right into the boardroom of the Bank of England. And the reason why there was a weather vane in the middle of the boardroom of the Bank of England was because when the prevailing winds shifted, central bankers, and we're talking about late 18th century, early 19th century when it was installed. The reason they had it installed was because when the prevailing wind shifted, that meant the vast English trade fleet was going to show up in harbor at London. They're going to sail up the Thames River and start docking and unloading their cargo, which meant that seasonally there was going to be tremendous demand for currency as those ships came in. If there wasn't currency, then you'd have all sorts of real economic issues in terms of pricing, inability to sell, deflation because cargoes would have to be discounted because there was a shortage of currency, all those kinds of. That's what central banks need to be able to be able to supply money when there's legitimate demand for it. Not be in the business of deciding what's legitimate demand, what's not legitimate demand, what is too much growth, what is too little growth. Economists, that kind of central top-down structure has never worked. It's not working now for various reasons. And so, no, I'm not in favor of doing anything like that. I think the central bank needs to understand that it has a limited role, needs to be shrunken back into that role, and hopefully by doing so, will make it a more competent institution in the one thing that it should be doing, not all of the things that it doesn't do really, really horribly.
Excellent. Thank you, Jeff. Jeff, this is Final Jeopardy. How many Eurodollars would you like to wager?
Well, since they're theoretically infinite, can I wager an infinite amount? Because my balance sheet isn't constrained right now. I mean, I don't have any of those kinds of problems. I've got central backing from Emil Kalinowski and the Cayman Islands, so I'm good. I'll wager an infinite amount.
I'm worried if you get the answer correct, then how do we pay you 2 infinites, right? And then if you get it wrong, does it all go to 0? It's very confusing when you wager infinite money.
No, actually, there's actually infinity is a variable. It's a graded term because there are larger infinities than other infinities. So if we start with one infinity, we can get to bigger infinities.
Jeff, I know this is not Eurodollar related, but I'm not going to let you go because you've just wrinkled my brain. There are larger infinities. Give us
infinities
a few
are
minutes
not
of
infinitely. Infinity isn't the biggest. Some infinities are bigger than other infinities.
Oh my God! Wow! Now everyone that's listening to this show, you've got to come back at least for the next episode. One day we're going to explore this. Jeff just does this whole Eurodollar thing as a hobby. He's really a physicist.
No, that would be mathematics, wouldn't it? I mean, it's come for the Eurodollar, stay for the math lessons.
All right, Jeff. You're waging infinite Eurodollars, but you're not worried because there's more infinites. And
I'll just wait for the central bank to do a bigger infinity of QE. So, I mean, that should fix everything, right?
Here is the question. Well, here's the answer. And the question you have to supply. Archibald Leach, Bernard Schwartz, and Lucille Lesueur.
Yeah, who are 3 people who have never been in my kitchen?
That is absolutely correct. Congratulations, Jeff. You are the Jeopardy champion. All right.
Thank you. It's such a great honor.
Did you know that I went when I was younger? Well, I know it's hard to believe. I look very young, but it's just the filtering. When I was younger, I applied for a Jeopardy, appearance, and they met at a mall. Kids don't know this, but they had malls back in the day, and you would go there. Anyway, so they had a lot of people go to the mall, and you would answer questions. And I was very surprised, but I never heard back. Am I not as smart as I think? How about you, Jeff? Did you ever apply to be on Jeopardy?
No, because I don't know, equating Jeopardy with intelligence or, being smart. I think that conflates things too, because it's basically, are you good at trivia? And that's a kind of a trivial pursuit, to put it in another direction. So I wouldn't be too broken up about something like that. It's entertaining, no question, but I prefer more serious scholarships and study than trivial stuff like that.
Outstanding, Jeff. I will talk to you again next week. I hope you enjoy 4th of July, and thank you again for participating.
Yes. Now that maybe next time you'll have to we'll design the program so that you can unseat me and take over as a Eurodollar champion.
I just want to be either Alex Trebek, or I'd like to institute some sort of Vanna White-like role for Jeopardy.
Okay. I guess that's where we're going with this.